Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Uh, I'm going to go through an article. It's talking about the dodgy demand data, the oil price collapse conspiracy. We've had a pretty good sell-off in oil, and the EIA is coming out with this demand data that is below COVID levels. And I'm looking at this going, there is no way that demand is that low. So I'm going to go through it. There's a couple of people with their opinions, experts. There's a quote from Valero, the CEO, saying that they're not seeing any demand destruction. So what the heck's going on? So let me go through here. We'll read basically the entire article here because it's got some good stuff in here. So looking at this, WTI oil prices have given up nearly all their gains since Russia invaded Ukraine, falling roughly 9.5% over the course of the week amid fears of oil demand collapsing. Some oil pundits are now claiming that the Biden administration has been fabricating low gasoline demand data in order to drag prices lower. While GasBuddy claims there was a 2% rise in gasoline demand last week, the EAI reported a 7.6% drop in demand. And this is, I mean, I'm not trying to get into any of these conspiracy type stuff, but I was looking at GasBuddy 2% rise, and then you get EIA and it's 7.6% drop. That's not like it's a point whatever percent difference. That's a mile apart in terms of demand data. And from what I've seen, just me looking around, traveling, we are more like a 2% rise than we are 7.6% demand drop. And we are nowhere near COVID levels. There was no one driving on the road. There's a lot of stuff that I'm seeing everywhere. So looking at this, WTI oil prices fell to the lowest point since early February. WTI has lost 9.5% over the course of a week, making the largest 1 week percentage decline since April. Amid growing fears that oil demand will collapse when Western nations descend into a full-blown recession, I will say this, it is very hard for demand to collapse from weakness. We've only seen it a few times in history over the past 50 years where actually demand collapsed. 2020 was one of those times that we stopped the economy at that point. We also had the 2008 blowout recession, and that was driven by the housing market. We're not going to have a deflationary recession, at least in the next, I think, year from housing. We have to. It's going to take longer than that. But that's obviously my opinion. We'll watch the data. So coming on down, for months, refiners have been enjoying historically high refining margins with the profit from making a barrel of gasoline. That's that crack spread that I talk about. The building block for diesel and jet kerosene hitting a record of 68.69 in June at a typical Singapore refinery. The margin later settled in the high 30s a few weeks later. So their crack spreads or margin levels got cut in half. That's where the majority of the pricing difference is coming from. It's coming from the crack spreads. A level still nearly 4 times higher than the 1183 at the end of last year, and some 550% above the profit margin at the same time in 2021. But the crack spreads, that's what the difference between gasoline, a finished product, and oil prices, have now gone into full reverse, according to Refinitiv data. Asian gasoline margins plunged more than 102% in July to discount of 14 cents a barrel of Brent crude, a far cry from a premium of 38.05 a barrel they reached in June. And I know some people were asking me, should I invest in the refiners? And I said, no, you have to invest when the margins are really thin and that the margins are going to expand, not when they are massively thick. Asian refining margins have now crashed to just 88 cents a barrel over Dubai crude. A sharp rise in inventories from the United States and Singapore to Amsterdam. Refiners are being forced to cut gasoline output to minimize losses and switch to producing more profitable fuels. Asia's top fuel exporter is planning to reduce operating rates at its residue fluid catalytic cracking units. So here's the big conspiracy. So here we go. The collapse in oil prices has been so epic and unexpected that some oil pundits are now accusing the Biden administration of fabricating low gas demand data in a bid to hammer oil prices. To wit, in late June, the EIA shut down reporting for several weeks, ostensibly due to a server malfunction. But as Forex Live has pointed out, gasoline demand data has been consistently bad ever since the EIA returned. Maybe there's an issue with reporting, or maybe it's a conspiracy, Forex Live has declared. Even Wall Street's begun to question the EIA data. Bank of America energy strategist Doug Leggett has published a note titled, "Fall of Gasoline Demand Appears Grossly Exaggerated." For the week ending July 22nd, implied gasoline demand rebounded to 9.2 million barrels a day, a 1 million barrel a day increase versus the last 2-week average, and the second highest level of 2022. B of A wrote in the note to clients, curiously, the EIA reported a steep drop in gasoline demand shortly thereafter, prompting Piper Sandler, global energy strategist, to label the data crooked, saying the methodology left significant room for error. We are supposed to believe that in July, in the middle of driving season, we are only using 8.6 million barrels per day. That would be down 500,000 barrels a day from May of this year. That would be below the COVID low of 2020. So we ask all the refiners, we ask all the retailers, we ask everybody that reported earnings this season. Every single one of them tells you that their sales are not down materially from even pre-COVID days. Some report record high sales, he added. Piper Sandler's allegations are buttressed by U.S. refining giant Valero, asking about falling gasoline demand in the company's earnings call last week. CEO Gary Simmons had this to say. I can tell you through our wholesale channel, there is really no indication of any demand destruction. In June, we actually set sales records. We read a lot about demand destruction and mobility data showing in that range of 3% to 5% demand destruction. Again, we're not seeing it in our system. Further, alternate demand data from gassbuddy deviates considerably from EIA's. gassbuddy tracks retail gasoline demand at the pumps in the U.S. So according to gassbuddy, there was a 2% rise in gasoline demand last week, making the strongest demand of the year. This is what's weird. There was a 2% rise in gasoline demand, making it the strongest demand of the year, the strongest demand of the year. In sharp contrast, the EIA reported a 7.6% drop in demand for the same time period. The Biden administration certainly is gunning for even lower fuel prices. In an interview with Bloomberg on Tuesday, Amos, the White House's senior advisor for global energy security, said that the gas and oil prices need to go even lower while U.S. producers and OPEC Plus need to raise output. But Adam Button, chief currency analyst at Forex Live, notes, it's the Biden administration calling the shots now. And at the end of the day, traders have to trade what's in front of them. Right now, it's a crude chart that's breaking support after a major period of consolidation. That's not good. The calls for a recession are growing louder. Crude demand has a long history of following global growth. There are supply factors that will eventually be bullish, like the SPR releases ending in October. But that's months away, and OPEC is still adding some barrels. So that's the setup. That's the setup there. We have potentially some people playing with the numbers. Now, we could go lower in the short term. It very well could. They're releasing strategic petroleum reserve barrels. We all know this. We know this. You know it. I know it. We know they're trying to get this price lower. Now, the data, if you look at it from certain sources, is still very bullish, where prices should go higher. Just because something should go higher doesn't mean it will go higher. You'll learn this very quick after the years in the market and what they're trying to do to manipulate things and hold things down. And they may be successful at bringing it lower in the short term. But I don't think there's a chance that they're going to be able to hold this down for any length of time in terms of like months or years. They can handle months, but I don't think they can do it in years. So I think that's going to be a buying opportunity if they're successful at bringing this lower. And there'll be a buying opportunity in the oil companies. And that's where the opportunity is when they're in there messing around with stuff and the demand and supply has not really changed. That's the opportunity. So I think that they are playing with the numbers. The EIA is. I think gassbuddy is probably right. I visually see it when I travel around that there's a lot of demand for gasoline, at least. So that's what I've got for today, guys. If you like the content, give me a thumbs up, subscribe to the channel, and subscribe to the website, the Platinum membership below. If you guys want to know how I'm playing this, what I'm loading up on in terms of natural gas, what I'm loading up on in terms of oil, I'm going to be a buyer here if we get a pullback here. I've been a buyer, and I've been holding my investments for the long term. We recently had a question and answer session. I answered a lot of questions. There were some questions regarding interest rates. You know, what makes it, you know, if the yields go higher, if the yields go lower, why do I have a certain viewpoint, and what is that telling us? I went and described all of that. We went over a whole bunch of stuff. So that video is taped. I taped it. It's released, and it's on the website if you guys are interested in listening to it. And we've got a whole bunch. I've taped all of them of previous answer and question sessions. And you can see my midweek updates, all the stocks I've been buying. You can see how they've done and looked at the history too. But that's what I've got for today, guys. Hopefully you have a good day. We'll catch you next time. This is Finding Value.